we saw the Federal Reserve yesterday increase the interest rate by a quarter point. And that's the rate that the Federal Reserve charges banks to borrow money out of the government from the Federal Reserve, which then they flow through the economy eventually to loan to other people or buy government bonds or whatever. So the cost of money went up by a quarter point. A lot of people thought that it was going to go up by half a point. But it went up because of the 8% inflation, the inflation at 7.9%, the producer price index going up 10% a month for 2 months in a row. And just you see inflation washing through the system in all levels. And the expectation was when you had the highest inflation rate in 40 years, you had the highest producer price index rate since that index was created, that the Fed would stomp on it hard. Well, they didn't. They gave a pretty tepid response, a quarter point increase, with the thought being they're going to do a quarter point increase every month for the next 7 months as their means of kind of dealing with inflation. Here's the thinking here's what that means in my estimation. There's a lot of data that indicates that our economy is heading towards recession. And all the happy talk aside, we have a number of indicators that that's the case. Historically speaking, when inflation gets really high, it slows the economy down because it takes a lot of money out of the economy, sucks up money out of the economy. That's what inflation is. It devalues the dollar. And so because there's less buying power, because your money's worth less, it effectively is a massive tax on everything you buy. And that causes the economy to slow because your purchasing power is down, so you can't buy as much. So not as much needs to be produced, not as much needs to be shipped. And your overall gross domestic product goes down, and it goes down 2 quarters in a row, and that's called a recession. And so that's kind of the historical pattern. The fact that the Federal Reserve did not go a half point tells you that the Federal Reserve is extremely concerned that they don't want to push the brakes on the economy through raising the interest rates to the extent that they would precipitate a recession. And so this kind of, we're going to do an interest rate increase every month for the next 7 months is a way for them to back out of it any given time as the economy begins to slip. A couple of things for people who are trying to figure this out, maybe investors and others. What you need to be looking at is the 10-year bond rate for Treasury bills and the 2-year bond rate for Treasury bills. 2 years means that's how long, every you buy it for 2 years. If you hold on to it, it expires in 2 years. Okay, that's the length of the bond. 10 years, it's 10-year length. When the interest rate, typically the 10-year rate, it pays a higher rate than the 2-year rate. Okay, so the 2-year rate pays a lower interest rate than the 10-year rate, typically. But when you're heading towards recession, and particularly there's a signal, and it's worked most times, didn't work recently, but we had COVID get in the way, but it's worked most times. And that is, if the 10-year rate becomes less than the 2-year rate, what that says is investors want a higher rate of return for a short-term investment than they do for a long-term investment. And they want that because they don't anticipate that other investments are going to be very good. So they're pushing that higher rate of return for the short-term rates. And so those two, when they cross over, 10-year goes this way, 2-year goes that way. When they cross over, historically within 18 months you have a recession. My bet is you're going to be that's a lot closer. And it's largely because we're running out of labor force. And we have about 11 million jobs that are unfilled. And we have a pretty big problem in that there's more people who are going from 64 to 65, where they're at the age where they're exiting the labor force, than are going from 15 to 16. And so we have this drain of labor because of the aging population. And in other countries where that's occurred, like Japan, it has signaled that you're going to have pretty tough economic times. And a lot of factors have to go into play to try to offset that. I believe what will happen is you'll end up with high inflation, relatively high inflation. It'll moderate some. You're going to have relatively high inflation, and you have a labor shortage. So what do businesses do? What Intel's most likely going to do with their plant they're going to build, I think it's in Ohio. They're going to mechanize. They're going to use robotics and AI to take care of all the line jobs, and they will be paying people at the top end, top management level, and IT levels. But most of the jobs that would be by factory workers are going to be robotics, and even more so than you see in car plants now. And so you're just going to find yourselves and that's where the mechanization, when businesses can't find employees, it forces them to mechanize. And so you're going to see over the next 5 years a dramatic increase in the use of robotics and AI with the 5G technology and coming 6G technology, where there's very little latency between where a command goes, you don't get buffering, okay, to put it the best way. You don't get buffering. So if a command goes from the brain to the robot, it hits immediately. The robot can then report back to the brain, okay, well, I'm low on oil, let's say. Well, then the brain sends another robot out that either fills it up with oil, or greases its elbows or whatever it needs to do, or that robot leaves the lines, replaced by another robot. That robot gets repair made by a robot that's trained to do that, and then is in waiting for the next robot that needs to be replaced. That's the kind of mechanized system that's the factory of the future, as much as I hate to say it. And the labor shortage, the current labor shortage, combined with the lowering number of people who are in the prime 16 to 64 working demographic, combined with the high cost of labor, is going to precipitate that change much more rapidly than I think most people, most economists thought it was, and I think most futurists thought it was going to happen. And so the world's going to change a little bit because of this. And that's one of the things that we take a look at, because as that world changes, we have to make certain that civil liberties remain. We have to make certain that the ability of America to produce jobs for citizens remain, and that concepts like universal basic income, which would make the population completely, middle-class population, completely dependent upon the federal government for their livelihoods, not get put into place. Those are the kind of things that we have to fight against in order to keep economic freedom and personal freedom intact in this country.